Hi everyone, welcome to part 2 of what ChatGPT can't tell you about Asian stock investing. In part 1, we spoke about how the investment discussion is like in Fullerton Fund Management, as well as what you can do when the stock prices fall. In this second part, we are once again with Saurabh Chugh, Director of Equities, and Stephen Tan, Managing Director and Co-Head of Sales at Fullerton Fund Management. Hi guys, let's continue with our conversation, this time with a macro view. So, what is the potential future headwind and tailwind for the APAC region?
Maybe let me start off from a macro perspective. We have identified 3 Gs in this current macro environment. I think the first G itself is the great decoupling. So in the last decade or two, the world had a big kumbaya moment where all of us came together regardless race, religion. We kind of did things together for the sake of humanity, and we progressed a lot in the last 10-20 years. That said, I think we are seeing a big decoupling. We have seen regional globalization peak, and regionalization and fractionalization start to happen. And I think that would cause a lot of volatility, a lot of pain. It's like getting married is always easier than getting apart. Yeah. So the second one itself that we see is actually the Great Reset of interest rates. I think post GFC, we have seen interest rates just hit down one direction. Last year in 2020, we have seen a great reset. Our view is that interest rates has a bit more to go, and even when it peaks, there will be no rush to zero as before. So the low interest rate environment or the QE environment was like an anesthetic. We all grew very comfortable with risk assets, and we are starting to see that unwind. And as a result, the last G itself is actually the great volatility that we've seen starting to emerge at this point in time. So we feel that the asset classes will be more volatile. Risk management and active management is key in our opinion. That said, in terms of tailwind, Asia has done very well. In fact, if you look at this versus previous cycles, in terms of inflation, in terms of the currencies has remained very, very strong. So we do see that as a great tailwind, and Asia has come of age in our opinion.
Thanks, Stephen. I think that was a very interesting point from a more macro top-down perspective. Maybe if I can add a few points from a more bottom-up perspective to the same discussion. Because in the end, as we discussed in the previous episode, bottom-up fundamentals are probably which drive markets over the medium to long term. I think for the Asia-Pac region, while you're talking about the volatility being high, we do expect the cost of money, which is reflected in the form of interest rates, to be high as well. But there are some things which are going for Asia as well. And I'll talk about what's going for Asia in the long term, and then come to what's positive for Asia in the more medium to short term as well. In the long term, I think the very important point to consider is that GDP growth in Asia has been very, very strong over the last decade. It has been the powerhouse of growth over the last decade. But honestly, the returns in the equity markets in Asia have not been commensurate to the kind of the economic growth that we have seen in the region. And there's a reason behind it. Equity markets do not reward GDP growth or economic growth. Equity markets reward growth in corporate profits, or the earnings of the companies that we seek to invest in, which has not kept pace with the what's happened in the West, or what one would expect from a region which has been growing at a 4, 5, 6% kind of a rate for the last decade or so. However, we do expect this to change over the next 5 to 10 years. And there's a couple of structural reasons behind this. First one being that these things come in very long cycles. So if you look at corporate profits to GDP ratio, for example, Asia is probably sitting at a cyclical low. When I say cyclical, it's probably talking about 20-year high cycles, while the US market is probably sitting at a cyclical high. where corporate profits to GDP is above 200%. So that's point number one. So from a cycle perspective, we may be nearing the bottom of this very long cycles. Second point is, if you look at the structure of the Asian companies itself, or the kind of companies which are emerging in Asia, that's also changing. We are starting to see high growth, high margin companies start to emerge in Asia. So if you look at the composition of the Asian markets, right? In the past, it used to be very cyclical, old economy sectors which used to be represented in the market. Now, it's technology and consumer-oriented sectors which form the bulk of the majority of the equity markets in Asia. These sectors tend to have structurally higher return ratios, a better profitability as well. And to just give you an example, right? Over the last decade, rise of the Asian consumer was probably the most important consumer theme out there. But if you were to think who was the biggest beneficiaries out of this rise of the Asian consumer and the Chinese consumer, to be more specific, it was interesting that some of the Asian companies benefited, of course, but some of the bigger beneficiaries were actually in the West. These are the companies with the strong brands. So whether you look at companies like your European luxury good makers, which have derived almost their entire growth from Asia over the last 5 to 10 years, or even your sports goods wares or your technology, consumer electronic companies in the West, they've all benefited from Asia's growth. Going forward, we think Asian brands are starting to emerge. So the Asian consumer is going to spend on Asian brands. And that's going to be a big theme over the next decade or so. And the great decoupling, which Stefan talked about earlier, is potentially going to be another catalyst for that. Companies are also moving up the value chain. They're no longer just the last mile exporters earning 2-3% margins, but they are doing more R&D, having more technology, which means that they can earn better profits. This is a very, very important theme for Asia over the medium term. Why we are positive on Asian equities.
Yeah, I'd like just to add on what Saurabh has said in terms of the brands rotating back to Asia. So, case in point, if we are looking for a television, it's almost all Asian, Korean to be specific. And if you look at electric cars, the Korean, the Japanese, and the Chinese electric cars are amazing.
Yeah.
So it's a matter of time where some of these Asian brands start to rise. If you are talking about solar panels, nobody manufactures the solar panels anywhere close to the Chinese. So, the next decade could be Asia.
Well, thanks for sharing. Then, in the emerging markets, how do you ensure that companies are of good quality and not just growth for the sake of a growth type company?
Very, very important question. And as a fund manager, one of our primary jobs or one of our primary skills essentially is to kind of pick up the truth or to find out what's the truth from whole lot of information out there, right? Which means that we have as I say, the only way to make money is to get your hands dirty. And when I say getting your hands dirty is really going out, doing a deep dive, meeting the companies that you seek to invest in, meeting the people behind the companies we seek to invest in, and that would include not just your investor relation or the CFOs of the company, but actual people who own and run the company. And as fund managers, we do get access to these people, and not just them, the line managers who are running different businesses, their competitors, their suppliers, and then try to triangulate the information that we are being given. Is it correct or not? Do we need to, and we take a judgment call on that, right? So on how do we come about actually this whole, there's a lot of information out there.
Yeah.
We need to process all of it and then form a conclusion based on these different metrics.
Then the next question would be, fees are expensive. So what are your thoughts?
Well, fees are expensive. Fees are important. I think we should look at what fees we pay. That said, there's something even more important than fees. That is the after fees return. There's fees in everything. There's fees that are more transparent, like in unit trusts and mutual funds. The fees right down to the decimal place, how much is the expense ratio is published, and iFAST does a wonderful job in doing that. But the after fees return is where the rubber hits the road. Can fund managers deliver better after fees return than ETFs or other investments? I think in Asia, especially, we do. Fullerton runs a number of funds that deliver superior after fees return as opposed to the benchmark itself. In the developed market itself, where I think it's a bit more efficient, information is a bit more efficient, then the debate is out there. But quite clearly, within the EM, Asia, equity, fixed income, mixed asset space, we do deliver significant alpha over the market. So while it's important to look at it, again, after fee return is what clients should look at.
I totally agree with that, because what's good is an investment. If it's cheap but can't make money, right? Yeah. So the market isn't doing so well these days. What are your tips for investors who are cautioned and holding back their money by not deploying it? What are the tips that you can share with them?
I would like to use a quote by Warren Buffett. I know it's very cliche that time in the market is more important than timing the market. I mean, personally, what I do is after my bonus every year, I set aside different buckets of money. I pay the kids, I pay the wife, I pay myself, my retirement fund, and I have a bit left over. Maybe I buy a toy or two. But is the process of investing yearly, is the process of having a disciplined investment, I think that is really important. I mean, I can't time the market. If you ask me whether the market is going up tomorrow, next week, I don't know. But in 20 years when I retire, I think with a high degree of certainty, I know that my portfolio has done pretty well for me. That is my advice.
Yeah, I mean, absolutely, completely agree with Stefan here. Yeah, if you ask me whether markets will be higher 2 months from now, honestly, I don't know. But if you ask me whether markets will be higher 5 years or 10 years from now, I would have a significant degree of confidence to say I think so. And so that's something that one should always keep in mind, that short term it's very difficult to kind of time where things are going. But again to use a saying which has often been used, more money is lost waiting for a correction than in actual corrections in the market. So that's something that investors should always keep at the back of their mind.
Okay, then lastly, what would the both of you say is the strength of Fullerton Fund Management as an asset management house?
Well, I think the environment is very important. So the environment is, in my opinion, created by the ownership structure. A lot of listed companies tend to chase the quarterly returns, and they should. I mean, they have shareholders to answer to. So Fullerton is co-owned by Temasek Trusevioura and NTUC Income. I think both entities are very long-term investors, multi-generational type of investors. So that gives us the type of long-term thinking that is very rare and very unique, in our opinion. So that underpins the way we think, the way we process, and why we are able to create a conducive environment for delivering alpha for our clients.
Yeah, I mean, great points, I think, Stefan. Just to add a couple of points from what I think makes Fullerton quite unique is also, right, that we are a mid-sized manager. We are neither too large, we are not too big. So we are large enough to bring the kind of the rigor and the process and the risk management that you would expect of any big institutional manager. But at the same time, we are small enough to be nimble, to be essentially have the client service that you would expect of a boutique firm. So we try to bring the best of both worlds to our investors. At the same time, and another very important point, I think, which is often difficult to articulate, but is very, very important, is the culture. We have a culture which is very open, which is we encourage people to be, courageous, think out of the box, and be collaborative at the same time. And this is, I think, extremely important for a investment firm, because as I said earlier, right, an open debate is crucial to decision making. And this is something which has been fostered in Fullerton, over the years, and are really now ingrained into all of us.
Well, thank you very much to the both of you. This gives our two-part series with Fullerton Fund Management a nice conclusion. Once again, thank you Saurabh and Stephen for joining us today. Thank you very much.
Thanks for having us.
Thank you. It's our pleasure.